Greetings. Welcome back to IBI India Business Insights. Today, we are going to look at the regulations concerning private equity and venture capital funds in India. Private equity investment usually refers to an equity investment in a potentially successful company that is not traded publicly in the stock market. Private equity investments have become the leading source of equity investments in India. In 2021, around 2,000 deals were closed and about $38.5 billion of VC and growth equity was raised. Also, exits worth $36 billion was seen. Let's have a look at this flowchart to understand the structure of a private equity fund. Considering the growing importance of both the VC and PE industries and other collective investment, SEBI came out with the SEBI Regulations 2012. The purpose of this was to regulate all the funds registered with SEBI and also the various unregulated pools of capital under common regulations. As per these regulations, SEBI defines private equity funds as an alternative investment fund which invests primarily in equity or equity-linked instruments or partnership interest of investee companies according to the stated objective of the fund. The regulations divide AIFs into three categories. Category 1, AIFs which invest in startup or early stage ventures or social ventures or SMEs or infrastructure or other sectors which the government or regulators consider as socially or economically desirable. Category 2, AIFs which do not fall in Category 1 and Category 3 and which does not undertake leverage or borrowing other than to meet day-to-day operational requirements and as permitted in these regulations. Category 3, AIFs which employ diverse or complex trading strategies and may employ leverage including through investment in listed or unlisted derivatives. Private equity funds fall under Category 2. Private equity finance confers various benefits on the companies concerned as well as the industry, economy and society at large. The most important component for the growth of a company is to be seen capital and PE investments give this capital to the companies. Another important aspect is the company's financing structure and general management, which too is provided by the PEs. These investments are seen as company builders. With investment, PEs also bring R&D with themselves, upgrading human capital, improvement of environment and building infrastructure. Thus, PE benefits the economy at large. Private equity firms are known as natural system stabilizers. During a systematic crisis, PEs are able to balance the system by being a risk trader of their long-term funding requirements. A survey was conducted on post-buyout performances of companies in which PE investment had taken place. It was seen that the operating income of these companies had increased by around 40% in the subsequent 3 years. Survey by KPMG also showed that in India, share of the price of PE-sponsored companies grew by 195% against the non-PE-sponsored companies that only grew by 99% over a period of 2 years. Now, let's understand how a private equity fund operates. In a private equity, there are three parties. The issuers, they are the firm, business that are looking for the private equity investment. The intermediary, they are the private equity fund themselves, which may be in the form of a trust, limited liability partnership, company or a body corporate. And the investors, they are the contributors of capital to the private equity firm. In the first stage, the intermediary, after registering the PE fund as per the laws of the land, raises capital for the purpose of the investment. In India, it is mandatory for every alternative investment fund to have a certificate of registration from Securities and Exchange Board of India. For grant of certificate of registration, the applicant needs to file Form A. Form A has been given in Schedule 1 of the SEBI Regulations 2012. In the beginning of the form, the basic instructions for filling out the forms are given. Like, form should be complete, it should have all supporting documents, it should be legible, pages should be numbered, each page should be signed and stamped, signatures should be original, etc. Then the form proceeds with the general information of the applicant. Here, the legal structure of the applicant entity has been asked. It is to be noted that an AIF may be in a form of a company, a trust, LLP, or body corporate. The form also requires that the category under which registration is sought is to be mentioned in the form. Since private equity fund falls under category 2, it needs to be mentioned in the form. In case of AIF other than private equity, that category needs to be mentioned which suits the description of the fund. Sub-Regulation 4 of Regulation 3 gives a detailed definition of 3 categories. All AIFs belonging to Category 1 and 2 are to be close-ended. Submitting draft placement, a memorandum, is an essential part of an application for a registration certificate. Where the applicant AIF is constituted as a trust, additional details are to be provided. Basic information about the sponsor and the manager of the fund and details about other AIFs they are or have been a part of are also to be given. The details of business plan and investment strategy are considered an essential part of the application for certificate of registration. Further, details of previous litigation with respect to the securities market are to be provided. This information is not just about the entity that is or is being constituted, but also about all the key personals of the applicant entity. Lastly, it is to be ensured that the regulation is being complied with by the entity and its members. For this regulation, 10, 15 and 16 have to be complied with. The board, if deemed to be necessary, may ask for additional information from any applicant. Further, MOA or trust deed or partnership deed of the entity should permit the activity of AIF and prohibit making an invitation to the public to subscribe to its securities. Other eligibility criteria have also been listed under Regulation 4. The application has to be accompanied with an application fee, which is as follows. The board can either grant a final registration certificate or can grant an in-principle approval. When an in-principle approval is granted, the AIF may accept commitments from investors but cannot accept any monies till final registration certificate is granted. For the purpose of raising fund in India, the AIF regulations clearly specifies the do's and don'ts. Some of these are: alternative investment fund shall raise funds through private placement by issue of information memorandum or placement memorandum. The placement memorandum shall contain investment strategy, investment purpose, and its investment methodology. AIFs in India are only allowed to raise funds by way of issue of units. Each scheme of the alternative investment fund shall have corpus of at least 20 crore rupees. The investor cannot give an investment value of less than 1 crore rupees. However, investors who are employees or directors of the AIF or employees or directors of the manager, the minimum value of investment shall be 25 lakh rupees. An AIF scheme cannot have more than 1,000 investors, but where AIF is in form of a company, it will be subject to Companies Act 2013. Category 2 of alternative investment funds shall invest not more than 25% of the investable funds in an investee company directly or through investment in the units of other alternative investment funds. SEBI through its circular has made it mandatory for an AIF to also include details in tabular forms of fees and charges applicable to the investor, including the distribution waterfall. After raising funds, the capital is invested in private unlisted companies by purchase of their shares. The funds should be invested in high potential company and a clearly defined strategy should be adopted. Usually, the assistance of a management team is taken to restructure the issuer company for ensuring profits to the investors at the time of exit. A setup cost and management fee, typically of 2.5% per annum, is drawn down from the capital raised. Since PE investment is not done with an intention to maintain indefinite control over the issuer company, investors commit to this fund for a set period. In India, a private equity fund should be closed-ended and it should have a minimum tenure of 3 years. This tenure can be extended for a further period of up to 2 years. Currently, the Act provides for no maximum tenure. During this term, value-adding changes are done to the issuer company so that investors can realize capital gains by disposing of the equity held by the PE fund. Therefore, the final step in PE fund is exiting the investment. The AIF regulations provide that once the tenure is over, it shall be fully liquidated within 1 year following expiration of the fund tenure or extended tenure. There are 4 ways to exit. Initial public offering, by offering shares to the public. Secondary market, merger or acquisition. The company is sold for either cash or shares in other company. Recapitalization, business borrows money to fund a repurchase of equity, allowing the private equity investors to exit. Liquidation, this is usually a last resort, but when the company fails and there is no hope for recovery, the investors have to settle for what they can. The regulations state that a PE fund may be listed on stock exchange subject to a minimum tradable lot of 1 crore rupees, and listing is permitted only after final clause of the fund or scheme. Foreign investment. The AIF regulations clearly allow investment by foreign nationals. This is evident from the definition of AIF given in the regulations, which states that it is a privately pooled investment vehicle which collects funds from investors, whether Indian or foreign. It has also been clearly mentioned under Clause A of Regulation 10. Further, in April 2016, Reserve Bank of India issued a circular with respect for foreign investment in AIF. This circular gave permission for foreign investment in the units of investment vehicles registered and regulated by SEBI, which would include AIFs. Silent features of the investment regime authorized by the circular as given thereunder are: a person resident outside India, including a registered foreign portfolio investor and a non-resident Indian, may invest in units of investment vehicles. The payment for units of an investment vehicle acquired by a person resident or registered outside India shall be made by an inward remittance through the normal banking channel, including by debit to an NRE or an FCNR account. A person resident outside India who has acquired or purchased units in accordance with the regulations may sell or transfer in any manner or redeem the units as per regulations framed by SEBI or directions issued by RBI. Downstream investment by an investment vehicle shall be regarded as foreign investment if either the sponsor or the manager or the investment manager is not Indian owned and controlled, as defined in Regulation 14 of the Principal Regulations. In case the sponsors or managers or investment managers are organized in a form other than companies or LLPs, SEBI shall determine whether the sponsor or manager or investment manager is foreign owned and controlled. The extent of foreign investment in the corpus of the investment vehicle will not be a factor to determine as to whether downstream investment of the investment vehicle concerned is foreign investment or not. Downstream investment by an investment vehicle that is reckoned as foreign investment shall have to conform to the sectoral caps and conditions, if any, as applicable to the company in which the downstream investment is made as per the FDI policy or Schedule 1 of the Principal Regulations. Downstream investment in an LLP by an investment vehicle that is reckoned as foreign investment has to conform to the provisions of Schedule 9 of the Principal Regulations, as well as the extent FDI policy for foreign investment in LLPs. An alternative investment fund category 3 with foreign investment shall make portfolio investment in only those securities or instruments in which a RFPI is allowed to invest. The investment vehicle receiving foreign investment shall be required to make such report in such format to Reserve Bank of India or SEBI as may be prescribed by them from time to time. Grievance redressal. SEBI has a web-based centralized grievance redressal system called SEBI Complaint Redress System on their website, where investors can lodge their complaints against any intermediary that is registered with SEBI. On this website, an investor can lodge their complaints, track status of the complaints, and track the status of readdressal of their complaints. All this takes place in an automated environment, helping reduction of paperwork and quick readdressal of grievances. However, filing complaint in physical form at offices of SEBI is also permitted. Private equity funds in other jurisdictions. In USA, as given under Investment Company Act 1940, a private fund is not required to be registered as an investment company under the federal securities laws. Therefore, it is not regulated by the Investment Companies Act 1940. This also means that private funds cannot offer their securities publicly. However, Investment Advisor Act 1940 requires private fund advisors to be registered with the Securities and Exchange Commission. They make investment decisions on behalf of the fund. These have to be according to the fund's investment strategy. Raising capital in private funds from investors is done through exempt offerings. This means they should fall within the exemptions that are given under Securities Act 1933. Generally, the rule is that there should not be general solicitation for raising capital. In Australia, depending on the fund structure, managing entity needs to be established to act as a trustee of Australian Unit Trust. As the manager entity, it shall hold an Australian Financial Services Licence under the Corporations Act 2001. Australian PE funds are not themselves regulated. This licence generally does not include dealing with retail investors. Apart from this, there are no other regulatory restrictions on PE investors. However, the PE fund may self-impose certain requirements and restrictions on investors to ensure compliance with anti-money laundering and counter-terrorism financing laws. The lock in the period for funds is at least 5 years but not more than 15 years. In Japan, a person managing the PE fund needs to be registered as a financial instruments business operator and will be governed by the Financial Instrument and Exchange Act. However, certain exemptions are given under the legislation. They do not need to be registered if they comply with certain provisions are given thereunder. One of them is that investors of the fund include at least one qualified institutional investor and not more than 49 QII. Even the non-QIIs should be eligible to invest. It is eligible if it is a listed company, legal entity with JPY 50 million or more of paid-in capital, legal entity with JPY 50 million or more of net assets, foreign legal entities without any particular asset or capital threshold, officers or employees of QII targeted fund operator and their family members, or the investment advisor of the QII target fund operator or their officers or employees. Though the regulations are robust, it does not mean that the investment has hurdles or is not very lucrative. Such regulations are only in place to ensure investor protection. SEBI has recently made amendments to these regulations in March 2022. SEBI is quite in tune with the markets and is able to make appropriate changes to these regulations. These regulations are thought to have performed well in regulating the Indian PE markets. Thank you for watching. If you like this video, do let us know in the comment section below.